Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, head of non-dollar rate strategy, and I'm joined today by our global market specialists, Nevruzi and Joann Spadigam.
All right, I'm going to take it over from here, and I think this week we should kick off with the UK. We had a ton of data coming in, pretty impactful data, and influenced markets not a lot in the UK, but also spilled over into a little bit into my purview out here in the US too. So, frustrating way to wake up one of those days. But I'll let you talk a little bit more about kind of what we got and maybe discuss the implications.
Yeah, sorry about that. Must have been a bit of a rude awakening. So the big data week this week in the UK, which we've kind of been looking forward to because, to be honest, it had been very quiet from a macro perspective in the UK. We'd had no data, we've had no central bank speak really. So we were kind of treading water. So finally, a little bit of excitement. The key prints, of course, which we knew heading into this week, was the wage inflation, as part of the overall labour market data set, and then the inflation data. It was a bit mixed. Wage inflation came in a little bit softer than expected, and overall inflation came in a little bit stronger than expected. And as ever with these data sets, there's various different prints and different narratives. And so I think, whatever your prior view was heading into this week about the stage of the cycle that we're in or the central bank reaction function, you could probably find something in this data that would have justified your kind of prior views. That said, markets latched on to the higher than expected inflation print, and that was what really drove the market reaction, as you said, Jan, not just in the UK, but really globally in fixed income. I think if you look at the inflation print in isolation, it was only a kind of 0.1, 0.2 percentage point upside surprise versus expectations. A sell-off of the size that we saw yesterday on Wednesday seemed quite outsized relative to that beat, especially once you consider that in the context of wage inflation the day before, which was lower than expected, and once you consider it in the context that both wage inflation and overall inflation are now well below the Bank of England's forecast, and particularly with the inflation print, the core month-on-month print has been quite volatile of late. So it's difficult to read too much into any one print. And that goes as well for the downside surprise that we had the month prior. But of course, this data came, at the same time as a slew of kind of hawkish central bank speak, which I think we'll come on to because that central bank speak was kind of elsewhere, not just in the UK, but also when other data that we'd had globally, particularly in the US, but sort of in the Euro area as well, that kind of pointed in the direction of this idea that the kind of last mile of inflation is still going to be the hardest to tackle, and that's what central bankers will be wary of. Getting kind of favorable base effects make it very easy for headline inflation to come down from double digits or close to double digits back towards kind of 3-4% globally, but actually getting from that 3-4% back to the 2% target is not going to be a linear path. And I think central bankers are wary of that fact and the upside risks to current inflation prints. For me, though, I think there's a couple of points that I would make about the data this week. Firstly, on the wage inflation side, of course, it's encouraging for it to still be coming down a bit more than we thought. But, at 6% on the headline average weekly earnings number, that's still much higher than the Bank of England's 2% target. And also it's worth remembering that wage inflation data is only up until November. So it doesn't yet cover the key months, which the Bank of England is going to be wary of. And, when we talk about the early year wage setting process, what we really mean there is the wage inflation data in January and in April, which we won't get until 2 months after those months. So this is kind of lagged data, if you like, a lagged look at the wage outturns at the end of last year. And when we look at the survey data, it's much less encouraging than the kind of official headline average weekly earnings. I think we already spoke on this podcast about the BOE's decision maker panel survey, which shows wage expectations have not only bottomed out, but started to tick up last month. And we saw a similar pattern in the Indeed wage tracker as well this week, not just in the UK, but in the Euro area too. On the inflation side, the caution that I would just raise is that service inflation is still showing no real signs of moderation. And that's particularly problematic in the UK if the Bank of England is also now concerned about upside risks to goods price inflation from shipping disruptions. Service inflation still running at a very sticky 6% is not consistent with their 2% target. And finally, whilst it's true that both wage inflation and overall inflation are much lower than the BOE's projections in November, I would just utter a word of caution around expecting big downward revisions to their market rate assumptions at the next set of projections, which is the week after next, because there's also been a big repricing, of course, in central bank expectations. So a much easier bank rate policy would naturally revise up their inflation projections over the 2 and 3 year horizon. So you've got a bit of an offsetting factor against that lower starting point. So I guess to summarize that, then really what I'm trying to say is that there's nothing this week that's made me believe that we should be changing our Bank of England rate call. I'm fairly comfortable with the idea that they're leaning still towards later rather than earlier cuts. We have 100 basis points of cuts in this year in our central scenario in August and in November. The market's kind of adjusted quite a long way towards our view in terms of the overall scope of easing. If anything, markets are still expecting a slightly earlier cutting cycle than we have. Like I say, we don't expect the first cut until August. But, I still think, as I said last week, that the BOE are very focused on the upside risks, and nothing in the data that we've had this week, I think, make them any less concerned really about the outlook for wage inflation or inflation as a whole. And that will keep them cautious into the summer, we think.
And pushing a little bit past the very front end, the BOE, after this recent sell-off in gilts, we have reached your 4% target in the 10-year gilt yield. What do you think is the direction of travel from here onward?
Yeah, I guess full transparency that listeners who listen to our year ahead podcast episode will know that 4% in 10-year gilts was our year-end 2024 target. So I don't know that we can necessarily claim victory having met it on the third week of January. But of course, those people that did listen to that episode will know that at the time that we set that target, yields were much higher, and we expected yields to remain high into the early part of 2024 and only rally back down towards that 4% in the second half of the year. What we actually saw was a monster rally into the end of 2023 and then a kind of partial reversal of that into early 2024, back up to 4%. And what's really driven the first leg of that repricing back up to 4% has all been about this repricing of, central bank expectations. We got to very stretched levels at the end of last year. The market was looking for, 150 basis points of cuts, and we're now back at kind of 100 basis points of cuts, which, as I said earlier, I think is much more reasonable. But the way I see it, this kind of repricing of a central bank expectations doesn't just matter for the front end of the curve. It kind of matters all the way across the curve, not just because, of course, the level of front end rates matters for the rest of the curve, but also because, I think rates have been relatively well behaved when we think about the supply outlook so far this year. It's been very well absorbed. And part of the reason that it's been so well absorbed is because of this kind of market pricing of an imminent policy pivot. There's been this kind of FOMO, bid for duration, everybody looking at this, at these supply events as being the last events where you're able to lock in these higher yield levels. And the further that we push this kind of policy pivot out into the future, the less that this FOMO bid for duration exists, and therefore the less easily that supply is absorbed by the market. And so whilst we have the first leg of repricing driven by the front end, I think that there's still another leg of higher yields to come as the supply struggles to find a home in a bigger way than it has so far this month. So I think the direction of travel is still towards higher yields rather than lower yields from here. I think we could easily see, I don't know, 420 or 430 before we get back to kind of 360, let's say, in 10-year gilts. And if it is a sort of supply and demand-led repricing of the curve, I think that too should come with a curve steepening rather than a flattening from here, as the front end, remains relatively well pinned in this new, more hawkish or relatively more hawkish rate environment. But that's probably enough on the UK, because there's been plenty happening elsewhere this week too. It's not just all been about the UK. Joann, let's go to Europe, because although we haven't had a huge amount of data, it's been a very busy central bank speak week, should I say. We've heard from lots of members of the Governing Council who have all had quite a lot to say on their opinions of when rate cuts might begin, if ever, according to some of them. What's your take on all of that, and how has that changed your view on the ECB over the next couple of months?
It's been a fairly interesting week. I think a lot of ECB speakers have come now and pushed back quite aggressively on market pricing for early cuts. If you remember, just last week, we had a couple more dovish speakers sort of suggesting that the wage inflation data coming in around May is not necessarily going to be the thing that drives the rate decision-making process. But that really shifted quite swiftly this week, where it seems like the growing trend in the ECB Council is that they expect rate cuts to come in only by the summer. And we've seen front ends reprice as a function of that. And as a result of that, we've also shifted our ECB core now. So we are now expecting cuts to come in, or our base case for cuts rather, is for June 2024, where we expect actually that they might even cut by 50 basis points versus 25 basis points, given that they've delayed things a little bit. I do think that even though we've shifted our base case to a cut in June, I think it's important not to discount that there still really is a risk that we could see cuts come in early. The ECB does remain data dependent. And if our base case for the inflation forecasts do materialize, we could even see that in the February inflation print, which comes in just before the March meeting, that actually we see inflation moderating quite a bit and already below 2.5%. So, I mean, I think the risk really is still there and does exist, that we could see early rate cuts, but clearly a lot less pronounced than it has been in the past. I'm sure that the ECB is having discussions within themselves, and there will be a layer of caution around what they're communicating to the market. So I do think that the market is pricing in April and March fairly in line with how we're seeing things, and that's fairly balanced. So we're not pushing on pricing too much at this point. But like I said, we are expecting a base case of June, but there are risks still that we could see that come earlier.
It all comes down to the data, I suppose, then, for the next couple of weeks or even the next couple of months. Which data specifically, other than obviously just the headline inflation rate, will you be watching most closely that might, bring March or April back as a real serious consideration for you?
So the data that remains really important is the wage inflation data that's been mentioned multiple times. And like we've said before, even though the final print comes out in May, we will get an indication of where these numbers are headed earlier, even by March, from some sectors in some countries. So I think if we are getting a clear trend in the data earlier on in terms of wages, that will be important. The ECB doesn't only look at the wage negotiation data. They are tracking wages more frequently. We get things like the Indeed wage tracker data as well. So there is a whole range of wage data that is being watched. And I think that will continue to be important. And related to that, of course, Lagarde mentioned services inflation at 4% in December. So that remaining quite high as well. So services will be important to watch. I think the other two things that will be important is profit margins which the ECB have talked about a lot before, as well as shipping costs and how that has impacted inflation. I think that's obviously something that central bankers around the globe really are a bit concerned about at this point. So that's, again, something to keep an eye out for in terms of the inflation side. But I mean, I think it's also important not to necessarily discount things changing on the growth picture. We are fairly sanguine on growth for this year, but if we get a shift in the macro in that case as well, that again can prompt earlier action. But for now, inflation remains the focus.
Okay, Jan, plenty of data out of the UK, not the UK, in the US as well this week, which also was quite strong, and I think kind of helped exacerbate the sell-off that began in the UK. It looks now like we have a more complete picture of the consumer, which seemed to finish the year in Q4 on a relatively strong note. What's your takeaway of the data that we've seen this week, and how does that play into what your implication or what you're thinking about the Fed over the next couple of weeks and months?
So incrementally this week we learned that the consumer finished off the fourth quarter on a very strong note. Perhaps the most high profile data that we got was the retail sales release, which showed a 0.6 increase just in December on a headline basis. That was, to be honest, the headline level was largely driven by auto sales. But even if you look past that, when you start narrowing down to core or like a super core metric, that's like what we call like a control group that feeds directly into the GDP. Well, that increased by 0.8% on a monthly basis. That's coming after upward revisions to the past 2 months at 0.5, 0.1. So Q4 is likely going to be on a solid, perhaps slightly above trend in consumer spending, and shows that the year finished off on a strong note. There's a couple of caveats, right? So it's this December data, and you always have not always, but like you have a surge in spending around the holidays. So a lot of the core gains were driven by things like non-store retailers, clothing. Most likely a lot of it is, I don't want to call them a one-off type of thing, but seasonally increasing holiday-related spending. Nevertheless, consumer was in pretty good shape in Q4, at least from a spending perspective, and that should be reflected in the GDP for Q4 when we get that data. Of course, that is also nominal series. I don't want to downplay the strength in it, but it was nominal series. So you have to deflate that against inflation and how prices have changed. So something to keep in mind. And, it's like an upward trending series with population growth as well. So other than that, still pretty strong on a monthly basis. Hard for me to just look past it and say, all right, data is collapsing. It's certainly not. Additionally, we got another print of the weekly jobless claims. We get that every Thursday. This morning, it was something like in the 180 handle, right? So I want to say 187, but I forgot the exact last figure there, so I don't want to commit to that as I came here. But the important thing is it fell below 200,000. Again, end of year data tends to be a little bit noisy around there, but we're getting a lot of allegedly noisy data that's supporting that's not supporting a crash, right? So things are looking still pretty good for the labor market, even though Governor Waller even earlier himself said that he expects the December. The latest payroll data that we got to be revised higher. It's still hard to make the case that the labor market has shown some serious cracks. And what does that mean for the Fed? Well, it's really got me thinking, whether the Fed will actually lean into the pricing and start cutting rates. But let's just say they did that, but then the economy kind of maintains this path of relatively strong, if anything, above trend growth. I think that kind of lends credibility to our steepener view, but from like a different perspective, as more weakness and kind of further out the curve. But it could also, in the near term, it meant that we priced out some of the immediate expectations for the Fed. We had gotten to a point where markets were implying something like an almost certainty for a March rate cut. It was around like 96%. Now that's come a lot closer to 50-50. So as a reminder, we don't expect the first rate cut to come before May. But a lot of times market pricing markets can get ahead of themselves, but they also can usually guide the Fed into taking an action, or at least makes their action much faster. And if there's of course a credible case for the Fed to lower interest rates, even if growth is still strong because of inflation is coming down, to just kind of keep policy more neutral on a real basis, inflation adjusted basis. So we still think you get rate cuts, but this week's data didn't really promote the idea that they should be in a rush to to take an action at March or anything like that in March.
Yeah, and I think that's a kind of a global view, which obviously makes sense and has driven a global repricing. Just to fact check you there, you were correct. It was 187. So no need for us to go back and re-edit that. Away from the data a little bit, we're recording this on Thursday, so it feels like a while ago now. But we did have I guess the official beginning of the US election process with the Iowa primaries earlier this week, as is the case with the kind of primary and caucus season. The next one will be just around the corner. So although that feels like a long way away, perhaps even when someone is listening to this, we will have had the votes in New Hampshire. It felt like it was a moment which kind of focused people's minds on the US election, which, although are a long way away, certainly candidates could be well known for definite pretty early on in this year. So it felt like Trump's victory in Iowa did have a bit of a market impact in terms of yields higher and perhaps curves a little bit steeper. What do you see, or how are you thinking about the path for the next couple of votes in the US and the election as a whole as we near that polling date in November?
I mean, I think you're right that I feel like after what we got in Iowa, interest globally immediately sparked on the U.S. elections. Until now, it felt very, very dormant. No one really cared, and now it's become center stage of a lot of discussions. We're certainly getting a lot more inbound questions on market impact. So, of course, listeners from now on will get a ton of coverage from the political side and just kind of a lot of commentary on purely from the political side. I'll try to keep this much more markets related, but just to kind of give like a recap to people who are not as close to following, we hit kind of like the first set of primaries starting in Iowa, where Trump did take the lead. He won 98 out of 99 counties, basically getting a 51% of the vote, which kind of symbolically tipped him over to 50%. A pretty dominant performance from Donald Trump, even though he wasn't at the debates or anything like that. However, that doesn't really mean that by any means that it's the deal is sealed for him. Next step will be the New Hampshire primaries, as you pointed out, and that's a bit of a different beast. So currently, Nikki Haley is actually catching up in the polls. There's still a meaningful gap between Trump and Haley, but she is rallying ahead of those primaries. And the difference between New Hampshire and Iowa is that in New Hampshire, everyone can vote regardless of their party affiliation. About a third of the state is technically independent. So there's definitely a much bigger swing factor there. And that tends to be a lot more kind of predictive in terms of who ends up being the nominee. So it's definitely not over. It's not a lock, but so far clearly Donald Trump is the forerunner, but it's not a sealed deal. And as far as markets go, we were looking at historically how not just rates perform, but also how volatility behaves in an election year. And a pattern that stands out is that during kind of like mid-February to kind of like mid-March, I know some of the years you had like 2008, 2020 in the mix, but even if you look past those, you kind of went back a decent amount where you don't have implied volatility with substitute for realized volatility. You can kind of see that mid-February to mid-March tends to be seasonally the highest period of volatility. And maybe that's because you kind of head into these like so-called Super Tuesdays where all these, the final candidate for the opposition emerges or the new president emerges from either single or both parties. You just have this kind of a lot more clarity coming in, or like, I guess, build up before the clarity coming in. So if history rhymes in this case, you would expect to kind of see this market action pick up in the next, we call it like 3 weeks or so. Currently still feels pretty early for us, but there's still some time. And as we head into Super Tuesday, which is kind of the first Tuesday in March this year, it tends to be for the Republicans, that will be that should be a much more heated and kind of market impactful point. And as far as how we see, each outcomes in the coming election impact markets, and I'm sure we'll talk about this more in the coming months, but subjective probabilities are still pretty hard to ascribe. I would say probably the lowest outcome right now looks like a President Biden winning with a Democratic sweep from today's perspective, but both currently President Biden winning and a Democratic or like a gridlock Congress, or Donald Trump winning and a gridlock Congress, both still imply relatively muted action, because you would see, fiscal spending suppressed or kind of like be left on a neutral stance, maybe a little bit through executive orders, but not much like a meaningful deficit impact. On the other hand, a situation where either candidate wins and manages to get like control of Congress, then you're certainly going to see a lot more fiscal pressure, perhaps even a little bit more if we get the Donald Trump side, because you would expect to see these tax cuts that were enacted during his presidency, which are set to expire in 2025, to get renewed. The tax cuts on the TCJA Act. On the other hand, President Biden similarly has other deficit enhancing initiatives like student loan forgiveness, or some like tax credits, child tax credits, other things like clean energy subsidies, and so on. So both of those things should add some pressure to, typically perceived as like a pressure to the long end of the curve. When President Trump won in 2016, we had a bear steepening, so longer end yields moved up faster than shorter dated yields, which was reversed in the coming months, but like that was a knee-jerk reaction. So I don't think we have the shock factor this time around, but it should still follow a similar pattern if that were to be the case. So let me stop here this week, and there's still a lot of uncertainty, and we will try to give this mini coverage in the podcast. But once the news coverage picks up, I feel like by the time the podcast is released, everyone will have a ton of news in front of them ahead of who, what, and when.
They'll be inundated with it. Oh, well, just what we need, a source of more market volatility over the next couple of weeks. But as you say, I'm sure that's something that we and many other sources of information and discussion will be talking about over the next weeks and probably months, because right now it feels like a long time away until the beginning of November. But there we go. Lots of political discussion to talk about this year, not just in the US, but of course in the UK and elsewhere too, which we'll return to many times in coming episodes. Okay, let's leave it there this week. Thank you both for joining me. Thank you to our listeners for listening in. And just a reminder, if you liked today's episode, please don't forget to hit the like button and click subscribe so you can get the latest episodes as soon as they're available. Thanks. See you next week.